Introduction. In Section 2.3 we discussed the first component of the primary goal of accounting, which is to determine the financial position of an entity as it is reflected in the Statement of Financial Position. In this study unit we discuss the second component of this primary goal, namely, the financial performance of the entity, and indicate how it is reflected in the form of a statement of profit or loss and other comprehensive income. 3.2 The financial performance, result. The financial result of an entity is measured in terms of the profit or loss that the entity has made over a specific period, which is referred to as the financial period and which is normally a year. An entity makes a profit when the income it has earned is more than the expenditure it has incurred in generating or producing that income. The difference between income and expenditure is known as a profit or a loss. Profit is a business owner's reward for the capital he/she has invested and the entrepreneurial spirit he/she has shown. It therefore increases the equity of the business. The statement of profit or loss and other comprehensive income of a business provides information about the results of the operating activities of the business in a specified period, that is, its performance. The heading of the statement of profit or loss and other comprehensive income identifies the period on which it is reporting, for example, XYZ Traders. Statement of profit or loss and other comprehensive income for the year ended September 30, 20.2. The statement of profit or loss and other comprehensive income of an entity reports its income and expenses, including its gains and losses. 3.3 Income. Profit or loss is frequently used as a measure of performance. The elements directly related to the measurement of an entity's financial performance for a period in the statement of profit or loss and other comprehensive income are income and expenses. Income less expenses equals profit/loss for the year. The objective of every entity is to earn as large an income as possible. Income is the income that an entity earned through its normal everyday business activities in a financial accounting period, normally a year. Examples are sales, rent income, interest income, and credit losses recovered. Expenses are the running expenses that an entity incurred to earn an income in a financial accounting period, normally a year. Example are purchases, rent expenses, telephone expenses, water and electricity and salaries and wages. Revenue is income earned through an entity's normal activities, daily operating activities, for example. Gains are increases in economic benefits that do not arise from the normal activities of an entity, for example. Fees earned. Profit on the sale of non-current assets. Sales. Interest income. Rental income. Commission income. Credit losses recovered. When the double entry principle is applied, the following rules have to be followed. DR, debit side, equity, liabilities and income increases on the right, credit side and decreases on the left, debit side of the T account because income increases the profit for the year. Income is recognized when an increase in economic benefits through an increase in assets or a decrease in liabilities of an entity has arisen for the entity. It can be measured reliably, Kopshar et al. 2017:21. Income is therefore recognized simultaneously with an increase in assets or a decrease in liabilities. In practice, it is normally required that revenue be earned before it is recognized. 3.4 Expenditure. Expenditure is incurred to earn income. Expenses are incurred in the normal course of an entity's activities. They arise from the generation of income. Examples of expenses are: losses or decreases in economic benefits that do not arise from the normal activities of an entity, for example, cost of sales. A loss on the sale of a non-current asset. Wages and salaries. Interest expenses. Rental expenses. Advertising. Credit losses. Insurance. Repairs and maintenance. Telephone expenses. Water and electricity. Postage. Rates and taxes. Stationery. Consumables. Packing materials. Bank charges. Depreciation. Administrative expenses. When the double entry principle is applied, the following rules have to be followed. DR, debit side, expenses, credit side, CR. The above can be summarized as follows. Expenses increase on the left, debit side, and decrease on the right, credit side of the T account because expenses decrease the profit for the year. Expenses are regarded as a decline in economic benefits resulting from a decrease in assets, or an increase in liabilities that can be measured reliably. Kopshar et al., 2017:22. Expenses are therefore recognized simultaneously with an increase in liabilities or a decrease in existing assets. 3.5 Influence of profit or loss on equity. Equity refers to the wealth of the owner of an entity. One can say that if the owner of a business closed down the entity at a particular date, sold all the valuables, assets, in the entity and paid all the liabilities, the amount left would constitute the equity. There are two methods by which equity can be calculated, namely, by means of the accounting equation and by means of income and expenses. Income, profit, increases, and expenditure, losses, decreases the owner's interest. Equity can be calculated by the following two methods. Method A, by using the accounting equation equity equals assets, liabilities. Method B, by using equity accounts. DR, debit side, capital, credit side. Business Traders Statement of Changes in Equity for the year ended December 31, 20.9. R. Cap. Statement of Profit or Loss and Other Comprehensive Income, Financial Performance. The financial performance of an entity is measured in the statement of profit or loss and other comprehensive income, previously known as the income statement. The correct statement of profit or loss and other comprehensive income for business traders is as follows. Business Traders Statement of Profit or Loss and Other Comprehensive Income for the year ended December 31, 20.9. Refer to an example of the statement of profit or loss and other comprehensive income in section 4.15.1 of Study Unit 4. 3.7 Statement of Changes in Equity. The purpose of the statement of changes in equity of an entity, refer to the example of Method B in section 3.5, is to reconcile the equity at the beginning of the financial period with the equity at the end of the financial period. The balance of the equity at the end of the financial period is then shown in the statement of financial position. Refer to an example of a statement of changes in equity in Section 4.15.2 of Study Unit 4. 3.8 Accounting Policies and Explanatory Notes. Additional information on items appearing in the financial statements of an entity is given in the notes to the financial statements. Refer to an example of notes to the financial statements in Section 4.15.4 of Study Unit 4. 3.9 Revision Exercises and Solutions. 3.9.1 Revision Exercise 1. How is the financial performance, result, of an entity calculated in accounting terms? Which financial report reflects the financial performance? Give 3 examples of income. Give 3 examples of expenditure. How is profit/loss determined for a financial period? Does a loss increase or decrease the equity of the owner of an entity? Solution: